Hello students, welcome to the lecture on claims management in life insurance. And after this lecture, we will be able to learn the following objectives. Explain the features of insurance claims. Discuss the principles of general insurance. Describe the theory of rating. Explain the role of Traffic Advisory Committee, TAC. Discuss the claim of settlement non-life insurance. Let's start with the concept of claims management in life insurance. Claims management is critical to an insurer's success. Done right, it solidifies customer relationships, aids in regulatory compliance, and prevents fraud. Many insurers have recognized the need to improve the efficiency of their claims management process. They have streamlined processes, eliminated paper-based forms, and redistributed work to match the demands to skills. The objective of their efforts is to lower costs while also increasing overall throughput. Efficiency improvements make tasks quicker and less costly to execute. However, to realize even great improvements in the claims handling process, insurers must also focus on the effectiveness of their claims decisions. Let us now discuss the features of insurance claims. Claim is a right of insured to receive the amount secure under the policy of insurance contract promised by insurer. Insurance claims cover everything from death benefits on life insurance policies to routine health exams at local doctor. In many cases, claims are filed by third parties on behalf of the insured person, but usually only the persons listed on the policy is entitled to claims payment. Stages in claims system. Basis of claims. Claims management means and includes all the managerial decisions and processes concerning the settlement and payment of claims in accordance with the terms of insurance contract. It includes carrying out the entire claims process with a particular emphasis on monitoring and lowering the claims costs. The important elements of claims management are claims preparation, claims philosophy, claims processing, and claims settlement. The claims philosophy is defined as procedure or specified approach to settle the claims. It contains the claims management principles and also claims handling methods and procedures. Claims management is a managerial function in which the insurer has a definite role to play in analysis of data, processing of application, decision making, budget planning, and business control and fund management. It is a subjective concept. In claims management, the attention is on making principles and guidelines for smooth and profitable settlement of claims in the hands of the insurer. Claims management includes the entire process of claim handling and claims payment. This includes review of the claims performance, monitoring of claims expenses, legal costs, settlement costs, compromises, and planning for future payments and avoiding the delay and disputes in payment of claims. Claims Management Department. The claims department is one of the key departments in an insurance company. The claims department has the following functions to perform: to provide the customers of insurance and reinsurance companies with high quality of service. This role gives a long-term edge to the company and hence is referred to as the strategic role. Types of claims. Understanding the requirements for various life insurance benefits is important for the customers. The overriding conditions on claims is the payment of premiums, that is, claims are only payable if premiums are paid up to date. There are various types of claims under life policies. Claims. This is a claim paid when the person insured dies. For a death claim to be paid, the following basic conditions must be fulfilled: the policy document, original death certificate, burial permit copy of the ID of the deceased must be provided to the insurance company. A report from the doctor who treated the deceased must represent to the insurance company. Claims forms must be completed. A report from the doctor who treated the deceased must be presented to the insurance company. Claim forms must be completed. A report from the doctor who last treated the deceased person may be required. A police abstract report may be required where death occurs through an accident. Procedure of claim settlement. Claim intimation. Requirement submission, if any. Final decision on the claim. Letter of intimation of death including proof of age, death certificate, policy number and name and address of claimant. Amount payable. The amount payable upon the maturity of the policy, that is non-happening of the event, is the sum assured plus profits and bonus that accrues with the policy. The profits are paid on pro rata basis, that is, in the proportion of the premium paid and declared are bonuses. The payment of profits is a condition inserted as a clause in the policy itself, and it becomes an obligation on the insurer to pay the amount of such profit as may be accrued to the insured. The amount insured or face value of policy. Bonus if declared by company. Share of profit in case of participation policy. Surrender value if policy lapsed.
And that's part one of our presentation today. You'll see that, there are the first aid claims. The first aid claims are applicable in California. They're not something that is available in Arizona. In Arizona, there is a requirement to report all claims. In California, if it is that you send someone to the occupational medical clinic and they do not prescribe any medication, maybe they just say take over-the-counter Advil, and there is no modified work, they're just released to full duty, that can in fact be a first aid claim. It is a determination made by the treating doctor, and this gives the employer the option to pay for that office visit to the clinic directly and not involve the insurance carrier. When you don't involve the insurance carrier, it doesn't affect your XMOD, it doesn't have to be reported on your OSHA log. So there are quite a few benefits to having first aid claims. It's not very often that you get a first aid claim, but if you can tell your occupational clinic that you're interested in utilizing that approach, it may yield you some results. There is a medical-only claim. That is where the employee goes to the clinic, receives treatment, gets a prescription, has a follow-up appointment. They may be released to modified duty, but there's no lost time from work. The indemnity claim, these are the high-dollar claims. They involve time lost from work, payment of temporary disability. All of these factors drive up the cost of the claim. And then there is a death claim. Hopefully none of us will have a claim of that type. And now we're going into the various components of the claim. The medical treatment, obviously, is provided by the occupational medical provider. Then we go from there into the temporary disability. This is the payments made by the carrier covering time that the claimant misses work. Permanent disability has to do with the permanent impairment to the claimant due to this injury. If perhaps an employee would have lost their pinky finger due to a work-related injury. And then we're going to talk a little bit more about this further on in the presentation. The rehabilitation benefits or the supplemental job displacement benefit. This has to do with the retraining for the injured worker to pursue another occupation. If they're not able to return to their normal occupation because of this injury, then there's a provision in both Arizona and California law to provide for their retraining.
Special case of claim insured in times of natural disaster. The death toll in the devastation in Uttarakhand could eventually far exceed the number of bodies found. The flash floods would have swept away many, while many would be buried under the rubble, never to be found. Most of them would be eventually pronounced as missing. In an effort to partially alleviate the pains of survivors and the next of kin of those missing in the aftermath of the calamitous flash floods in the hills, the Finance Minister Chidambaram on Tuesday asked the country's largest life insurer, the government-owned Life Insurance Corporation or LIC, not to insist on the usual condition that requires the passage of 7 years in case of missing people before death certificate is issued. Addressing an LIC function, Chidambaram said that the public sector insurer can get an indemnity bond from the claimants in such cases, and the claims may be settled on priority, and asked it to constitute a special team to settle claims of those affected in a centralized basis. The cases where there is no physical proof of death, claims settlement process may take many years. Now moving on to the next topic, we will study the principles of general insurance. All agreements are contracts if they are made by free consent of the parties, competento contract, for a lawful consideration and with a lawful object, and which are not hereby declared to be void. The insurance contract involves the element of general contract, the elements of special contract relating to insurance, the element of general contract, agreement, offer and acceptance, legal consideration, competent to make contract, free consent, legal object. The special contract of insurance involves principles are insurable interest, utmost good faith, indemnity, subrogation, proximate cause, contribution, warranties.
Today we're going to talk about general insurance. So depending upon if you're a business or an individual, those needs are going to vary. So if you're a business, a couple of things to keep in mind is there are some state mandated insurances that you need to worry about. So these are things like workers' comp, disability. As long as you're not the state of Texas, you're going to have these insurance. There's also things like, say, general liability. These are going to protect you for, say, trip and fall coverage, your property, business interruption, and also hired and non-owned auto. So depending upon the type of business you have, that'll probably take care of your needs. Another one to look at is E&O insurance. So depending upon if you're paid for your advice, so a lot of times architects, graphic designers, lawyers, those are people that are all paid for their advice and their instruction. So errors and omission insurance is going to be something that they're going to really want to consider. Another thing is if you're a business, you also might look at health insurance for your employees if you're going to have benefits that you offer. That in a nutshell is kind of an overview of with a business. As an individual, depending upon your needs, if you have a home, you're going to want to insure your home. If you have a car, you're going to want to insure the auto. If you need medical insurance because you don't have it through, say, an employer, you need to look at having health insurance on your own, as well as, say, life insurance. If you have a family you need to provide for when you're gone. So that's just kind of a general overview. It's very, very simple. I do encourage you to speak to an insurance professional because depending upon the type of business you have or the type of individual you are, there are going to be probably a lot of other coverages that you need to look into, but that's a brief overview of things to consider when you're looking to insure your business or you as an individual.
Insurable interest. For an insurance contract to be valid, the insured must possess an insurable interest in the subject matter of insurance. The insurable interest is the pecuniary interests whereby the policyholder is benefited by the existence of the subject matter and is prejudiced by the death or damage of the subject matter. The essential of a valid insurable interest are the following. There must be a subject matter to be insured. The policyholder should have monetary relationship with the subject matter. The relationship between the policyholders and the subject matter should be recognized by law. The financial relationship between the policyholders and subject matter is such that the policyholder is economically benefited by the survival or existence of the subject matter and or will suffer economic loss at the death or existence of the subject matter. When a person fulfills the above criteria, or when a person has such a relationship with the subject matter, it is said that he has insurable interest, and it is only then that he can insure. Indemnity. Insurance is usually a contract of indemnity. The insurer agrees to pay for actual loss suffered by the insured and no more. The purpose of the contract is to shift the burden of risk from the insured to the insurer. So, according to this principle, the insurer undertakes to put the insured in the event of loss in the same position that occupied immediately before the happening of the event insured again. Uses. To avoid intentional loss, according to the principle of indemnity, insurer will pay the actual loss suffered by the insured. If there is any intentional loss created by the insured, the insurers is not bound to pay. The insurers will pay only the actual loss and not the assured sum. Higher is higher in overinsurance. Utmost good faith. The doctrine of disclosing all material facts is embodied in the important principle utmost good faith, which applies to all forms of insurance. Both parties of the insurance contract must be of the same mind at the time of contract. There should not be any misinterpretation, non-disclosure, or fraud concerning the material facts. An insurance contract is a contract of abere me fide, that is, of absolute good faith, where both parties of the contract must disclose all the material facts truly and fully. Material facts. A material fact is one which affects the judgment or decision of both parties in entering to the contract. Facts which count materially are those which knowledge influences a party in deciding whether or not to offer or to accept such risk if the risk is acceptable, on what terms and conditions the risk should be accepted. In case of life insurance, the material facts or factors affecting the risk will be age, residence, occupation, health, income, etc. Subrogation. The principle of indemnity is also implemented by the principles of subrogation. This principle gives the insurance company whatever right against third parties the insured may have as a result of the loss for which the insurer paid him. So, the doctrine of subrogation refers to the right of the insurer to stand in the place of the insured after settlement of a claim insofar as the insured's right of recovery from an alternative source is involved. Principle of contribution. Contribution is a right that an insurer has who has paid under a policy of calling other interested insurers in the loss to pay or contribute ratably to the payment. This means that if at the time of loss it is found that there is more than one policy covering the same loss, then all policies should pay the loss proportionately to the extent of their respective liabilities, so that the insured does not get more than one whole loss from all these sources. If a particular insurer pays the full loss, then that insurer shall have the right to call all the interested insurers to pay him back to the extent of their individual liabilities, whether equally or otherwise. Proximate cause, causa proxima. The rule is then immediate and not the remote cause in to be regarded. The maximum is sed causa proxima, non-remote spectator, that is seeing the proximate cause and not the distant cause. The real cause must be seen while payments of the loss. If the real cause of loss is insured, the insurer is liable to compensate the loss. Otherwise, the insurer may not be responsible for loss. So, proximate cause means the active, efficient cause that acts in motion, a train of events which brings about result without intervention of any force started and working in activity from a new and independent source. Let's know the meaning of theory of rating. The basis rate for consequential loss resulting from destruction of or damage to property by the perils covered under the fire policy shall not be less than 1.25 times the full average rate of the items covering the contents of the process blocks of the premises occupied by the insured for the purpose of the business to which the consequential loss insurance applies, except where otherwise provided. In calculating the basis rate, the contents of any storage utility blocks, even if they are communicating with process blocks, should not be taken into consideration. For other businesses' premises where no manufacturing process is carried on, the basis rate shall be the 1.25 times the average rate of the contents of the whole premises. The average rate shall be the percentage which the aggregate net premium in respect of the whole annual standard fire and special perils insurance of contents of the process blocks and or for the whole premises as applicable bears to the aggregate sums insured on such contents. The Tariff Advisory Committee. Advisory Committee is a body corporate which controls and regulates the rates, advantages, terms and conditions offered by insurers in the general insurance business. The Advisory Committee has the authority to require any insurer to supply such information or statements necessary for discharge of its functions. Any insurer failing to comply with such provisions shall be deemed to have contravened the provisions of the Insurance Act. Every insurer is required to make an annual payment of fees to the Advisory Committee of an amount not exceeding, in case of reinsurance business in India, 1% of the total premiums in respect of facultative insurance accepted by him in India, and in case of any other insurance business, one Insurance Regulatory and Development Authority and second Tariff Advisory Committee powers, duties and functions of the authority development and growth of the insurance industry in India and in case of any other insurance business, 1% of the total gross premium written direct by him in India. Composition of the Advisory Committee. The Advisory Committee shall consist of the following members, namely, the chairperson of the authority ex officio, who shall be the chairman, a senior officer of the office of the authority nominated by the authority, who shall be the vice chairman, not more than 10 representatives of Indian insurers elected in their individual capacities by such insurers in such manner from such areas and from among such insurers or groups of insurers as may be prescribed. Not more than 4 representatives of insurers incorporated or domiciled elsewhere than in India but registered in India, elected in their individual capacities by such insurers in such manner and from among such insurers or groups of insurers as may be prescribed. The Advisory Committee may, from time to time and to the extent it deems expedient, control and regulate the rates, advantages, terms and conditions that may be offered by insurers in respect of any risk or any class or category of risks, the rates, advantages, terms and conditions of which, in its opinion, it is proper to control and regulate. Any such rate, advantages, terms and conditions shall be binding on all insurers, provided that the authority may permit any insurer to offer during such period, being not more than 2 years, but which may be extended by periods of not more than 2 years at a time, and subject to such conditions as may be specified by him, rates, advantages, terms or conditions different from those fixed by the Advisory Committee in respect of any particular category of risks, if he is satisfied that such insurer generally issues policies only to a restricted class of the public or under a restricted category of risks, As we have discussed that insurance is an important aid to minimize the effect of uncertainties of life as well as property, with the increasing complexities in personal and professional life, the range of risks that the insurance companies accept has also expanded substantially. The broadest classification of insurance is in terms of life insurance and non-life insurance, general insurance. A non-life insurance contract is different from a life insurance contract. A life insurance contract is a long-term contract, while general insurance contract is a one-year renewable contract. The risk, namely death, is certain in life insurance. The only uncertainty as to when it will take place, whereas in general insurance, the insured event may or may not take place. Maturity claim. It is a final payment under the policy of per the terms of the contract. Any insurer is under obligation to pay the amount on the due date. Therefore, the intimation of maturity claim and discharge voucher is sent in advance with the instruction to return it immediately. Claim concession. Normally, a death claim becomes payable so long as the policy is kept in force by payment of due premium. In other words, the payment of premium is stopped and the grace period expires, and if the death occurs thereafter, the policy is treated as lapsed or paid up depending upon whether the premium has been paid for less than 3 years and more. Under a lapsed policy, no claim is payable. In case of a paid up policy, only the paid up value is payable. Ex gratia claim. When a policy has not acquired pay up value and claim concession rules are not applicable. Nothing is payable in case of death. However, some insurers relax the rules in favor of the claimant. If the premiums have been paid for more than 2 years and the death occurs within 3 months from the first unpaid premium, full sum assured with bonus, if any, is payable. If the death occurs after 3 months but within 6 months. Now in the end, let us summarize what we have learned in this lecture. Claims management is critical to an insurer's success. Done right, it solidifies customer relationships, aids in regulatory compliance, and prevents fraud. Claim is a right of insured to receive the amount secured under the policy of insurance contract promised by insurer. A non-life insurance contract is different from a life insurance contract. A life insurance contract is a long-term contract, while general insurance contract is a one-year renewable contract. The claims handling is the integrated part of the claims management and executes the decisions made by the claims management machinery of an insurance company. If the life assured dies during the term of the policy, the death claim arises.